Welcome to the Debt Doctor podcast, where we deliver the definitive prescription for navigating distressed real estate debt. I'm your host and America's most qualified debt doctor, Bill Bymel. I've spent my career investing in, diagnosing, and reviving thousands of distressed real estate situations. The Debt Doctor prescribes proprietary remedies to help you identify, acquire, and monetize undervalued real estate assets. Each episode gives you insider access to the strategies top cohorts use to transform market volatility into double-digit returns. If you enjoy what you hear today, hit the follow button, subscribe so you don't miss an episode, and please share your support with a quick review. You can find me on the web at billbymel.com. Thanks for joining this episode of The Debt Doctor. Well, good afternoon, good evening, or good morning. Wherever it is you join us from today, welcome to the Debt Doctor and another episode of this podcast. If you like what you hear here, please like this episode, subscribe to the podcast, whether you're listening on YouTube, watching us, listening on Spotify, watching us, or listening on anywhere you get your podcasts. It really does make a difference if you share the Debt Doctor with folks. Thank you for listening. Today, we're going to delve into a very interesting piece of debt, of real estate debt, that really only exists, to my knowledge, here in the United States. So if you are listening or participating anywhere else in the U.S. and you find any other program like this program we're about to talk about, please leave a comment, share it with us, and I will be sure to bring that to the world's attention. But what we're here today to talk about is the reverse mortgage. The reverse mortgage. I say it again. It sounds like almost too good to be true. How does one get a reverse mortgage? But it really is a program that applies and is being used by millions of Americans already, or at least a few million. And there's millions more eligible to take advantage of this program. And here we are. We're going to talk about it a little bit today because we're going to start with today's program. This is the first of a two-part podcast series. The next episode will be what we do to make money off of the reverse mortgage program in a very, very unique way. Most people that are familiar with reverse mortgages, let me explain what they are, and then we're going to get into a little bit of a run through memory lane. I'm going to take you back to my past as a child and talk about one of my favorite shows growing up and how that actor has become a voice for the reverse mortgage here. Let's get started. First of all, the reverse mortgage, what is it? Let's start by explaining that the reverse mortgage is just that. It's an actuarial based debt product, meaning that it's not based upon the credit worthiness of the borrower. It's based upon a calculation of how long the borrower plans to sit on that debt before it's redeemed by the value of the real estate. So let me just take a step back. Millions of Americans own their home free and clear. And those people, for many people here in America, their home is their single largest asset. It's a forced savings plan. It's the only real asset of value. And when you look at the last 18 years since the great financial crisis, and I guess you could point back to about 13 years of positive growth in the value of real estate since 2012. More importantly, in the last 5 years, we've seen almost a doubling of residential real estate values on average across the board throughout America. 100%, in some places 150% increases in the value of real estate here in America just in the last 5 years. Now, that's a whole nother conversation. So we talk a lot about debt asset valuation bubbles here on the Debt Doctor. Make sure you click subscribe so that you listen to future episodes. Check out what we're talking about, because global debt and American debt and personal debt, all of these conversations are coming to a head, and they are obviously going to be a prescient topic the next few years. The reason that I'm talking about reverse mortgages is I invest in them. I buy them from the U.S. government, who insures reverse mortgages, and we'll get into that in a second. And that's one of the ways that I make money. But more importantly, this is not a program that I see the U.S. retiring anytime soon, pun intended, of course. The program applies to Americans over the age of 62 who own their home, either free and clear or with a mortgage. And what happens is that the U.S. government realizes that folks have these huge amounts of equity in their homes. And what they looked to do in creating the reverse mortgage program, which is a federally backed, federally FHA insured program, was to backstop and prevent predatory lending to seniors, or and really allow kind of an additional backstop to the Social Security system, which works in this which exists in this country, but many fear may not be solvent in the future. So let's just talk about how the program works, and the fact that it will be around for years to come, because especially as things become more expensive and more folks are on fixed incomes, really being able to access the equity in your home can really be a beneficial thing to the aging population. So I do not see this program going anywhere. If anything, there's more advertisements for reverse mortgages on TV every week. I see them. We're going to get into that in a second. And I see that there are more than 10 million, maybe tens of millions of Americans eligible for this program, especially if you're one of the 10 million Americans over the age of 62 right now that still has a mortgage. If you're looking down retirement, it's very difficult to look down at the age in your 60s, and if you've got a $2,000 a month negative burn on this mortgage payment, even if you got $1 million or $500,000 in equity in the home, if you're in your 60s, you still have to work to make those payments. What the reverse mortgage program does is it alleviates so many of those things. And it's really a benefit for those who utilize it correctly. Over the age of 62, the federal government comes in and is willing to insure, which is to backstop these mortgages, these reverse mortgages. And what they've done, the government did to create it with HUD, FHFA, these are federal government agencies that govern the FHA program. What they did was they created something called the Home Equity Conversion Mortgage Program. And that is synonymous with a reverse mortgage. Home equity conversion mortgage. I guess someone in a dark room came up with that and said, listen, this is a better way of saying reverse mortgage. Reverse mortgage maybe sounds negative, but the home equity conversion program, the HECMs, home equity conversion mortgage, you'll hear me refer to them now as HECMs from this point going forward. So these HUD insured HECMs, the banks are out giving these mortgages, and it's not based upon the creditworthiness of the borrower. So it's based upon the value of the home combined with how long the bank believes you are going to live. Now, I don't think they do like medical tests on a case by case basis. It's not that. It's an actuarial table. That's why I mentioned actuarial, which is also a reason why many of the major players in the reverse mortgage program, in terms of the originators, the lenders that are out there putting billions of dollars to work in this program, a lot of them are insurance companies because they already have the actuarials in place. So the bottom line is, let's look at it from the borrower's perspective. From a borrower's perspective, you're in your 60s, you're paying 60, you've got maybe 100,000 left on your mortgage. So it's not a huge payment, right? You $1,500 a month or something, $1,000 a month, on a mortgage that you've been paying off for 15 of 30 years or 20 of 30 years. Maybe you refinanced it after the GFC. Now you're looking at, oh, you want to retire. You can go to the bank and they're going to do a calculation of what your house is worth, which determines how much equity you have, in the home. If you own it free and clear, the equity you have in your home is what the house is worth. If you have a mortgage on it, it's the difference between what the house is worth and what you owe in your mortgage. Obviously, that's the equity left in your home. That's a chunk of change. That's an amount that the lender now says, okay, I'm going to either pay you out in one lump sum, or in many cases, so they, in the case of a $500,000 mortgage with a $500,000 home with a $100,000 mortgage, the government may say, okay, we think you're in your 60s, we think you're going to live for 20 more years. And so the house is worth 500 now. We're going to give you $350,000 now. That's going to pay 100,000 of that's going to go to pay off the original mortgage. You're going to owe 350, and we're going to make a payment to you of $1,000 a month. We're going to pay you. That's right. Well, the banks will, in many cases with these reverse mortgages, they'll actually add in a stipend. So you could either take a lump sum, you could take payments, or you could take a combination of lump sum and payments. And the only thing you have to do from that point forward is take care of the house, make sure it's insured, make sure the property taxes are paid, and survive. And obviously, one of the facts of life is that all life will end, right? So eventually this all comes to an end. The idea from the borrower's perspective, if you're in your 60s considering reverse mortgages, hey, my bet against the bank here, or against the U.S. government who insures this loan, is that I'm going to outlive what the government thinks I'm going to. And so it's this constant push and pull. Now, let's talk about how these things get made, where they come from, where the industry, where you might be familiar as a public person watching TV with, how you're kind of in the sphere, how the reverse mortgage program exists in the world, and then we can talk about a little bit of the data. And then I'm going to talk about how I get involved as an investor. And then part 2 of this podcast on the HECM reverse mortgage program will then get into the details of how we evaluate the value of these mortgages after the borrower has died and HUD is now selling those mortgages to the investor market. Okay, so I'm going to take you back to my childhood a little bit and share with you someone who is an icon of the 80s TV, and who has now become the spokesperson for one of the largest reverse mortgage lenders out there. I'm going to start by showing you the commercial that you may or may not be familiar with, that one of the many commercials that's out there being played on a regular basis for viewers. And for those of you who are just listening to the podcast and not able to see this, you'll hear the voice, and you should be able, the words are more important than the actual screen. Okay. Now that was Tom Selleck, for those that were not seeing you. So he has become the spokesperson for one of the largest programs out there. And that is Finance of America, as you heard, which, by the way, ironically, if you really follow the news, they aren't in the greatest of positions. They're actually were taken over by a private equity firm and all of that. So the program is catered towards the 10 million or so homeowners over the age of 65 who still have a mortgage, who might want to be eliminating the negative drag of making payments and just turn that into a reverse. And then obviously there's also, people who own their home free and clear. And as the economy becomes more difficult to live in, as we're all experiencing tighter times, it becomes more likely than not that more Americans will take out the reverse mortgage. Now, if you are a avid follower of YouTube or Google, or you like to research things through ChatGPT the way I often do, you'll find a lot of folks also. There's a negative connotation to the reverse mortgage, and there's folks out there that say it's a scam, that it's the way the banks are or the government's taking your home back. But, I don't get into, the Debt Doctor is not a political podcast. You'll very rarely ever see us take a side on what we think is a political issue. By the way, if you ever hear me say anything that's political, please drop a comment, anywhere you're listening or watching this podcast. We do try to keep a very objective point of view. But the reverse mortgage is a program that is not going. More and more people, if anything, if Social Security is not able to support our backstop, and people have these homes that are worth what I think is an inflated value right now, I would actually say that if you're a struggling person in your 60s, now may be the best time to take a reverse mortgage. Listen, you can always pay that mortgage off somewhere in the future. Now, interest rates are a little bit higher now, obviously significantly higher than they were 3 years ago, but the value of real estate is so significantly higher now, just in the last 5 years. We've really reached what I believe is a tipping point, the top of the market. As a matter of fact, residential markets factually in the summer here of 2025 are turning in the other direction. We've had a majority of counties in the U.S. go negative in residential real estate values since the beginning of the year. So remember, because this is not based on your credit score, because this is a mortgage that is based on the value of the property comparative to your age and how long you have to live, or how long the bank or the federal government actuarially believes you have the length to live, that's what determines the amount of the loan or the amount of the payments that you're getting out of the mortgage. Okay, so going back to the world of YouTube, and there's this whole other world that says these are scams. They're not scams. They are a federally insured government program, and most of the originators out there that I've seen are very, very, very by the book, very highly regulated. Just like the FHA program, the reverse mortgage program is not something that's easily defrauded. Okay, it's not. It is a program that, maybe there are individual brokers on the ground, or that are taking advantage of situations, or pushing people and to do these beyond their will. But in general, this is a choice of borrowers. This is actually a very interesting debt product, because when you think about it, loans are not, and a lot of the reverse mortgage companies advertise the fact that loan money is not considered by the IRS to be income. So if you all of a sudden start taking $30,000 or $50,000 a year as in a reverse mortgage payments on your home equity, that's all tax-free income. So there's a lot of benefits to those seniors that are aging, that don't want to move. They figure this is going to be the last home they live in. Maybe they don't have other savings, their other investments haven't gone well, or they never made other investments. But rather than having to work into your 70s or 80s or work so hard, you have the ability to now tap this reserve, this equity. I think it's a very good program for the right people. Where I do see a lot of animosity about it is from the heirs, of course. If your parents, most people of my generation, I'm 49, grew up with parents who were pretty frugal and worked pretty hard. Parents that were of the World War II generation, that were even World War I generation. And we got spoiled a little bit, I think. And I've met a lot of folks who expected, who are in their 30s or 40s and maybe or even in their 50s, who expected their parents to leave them something in their will. My father did not die with any money. My mother had a little bit saved up, but it made a difference at a time when I was raising a young family to get a couple $100,000 from a life insurance policy after she passed away. I mean, that really did make a difference in me as the next generation being able to help my kids up. I was putting my kids through private school. I mean, it made an actual difference. So where I see a lot of the animosity and the sticking point behind it is some families will do this without even telling their children or their next of kin. Now, if you do not have any heirs, this is probably the best thing for you. And I would say just go at it because, who's the money going to be left to anyways? You might as well take advantage of this program. How does it all unwind, right? And let's just look at let's look at the realities of the system now as it exists. So, like I said, it's an ironic thing because FHA, FHFA, HUD, Housing and Urban Development, a federal agency, they insure and govern the FHA program. The FHA program, for those of you who don't know, is a first-time home buyer program here in the United States. So that they insure bank lending people up to 97% of the value of their home when they purchase their first or second home. The FHA program can apply. It allows people who are just getting started in life to, with very little down payment, own their first home. And it's a great program. My father used to talk about it ever since I was a kid. It made home ownership possible for millions of Americans that otherwise never would have been able to own a home. Because if you can come in and put 3% down on a $200,000 home, that was a realistic thing. As a matter of fact, my parents had FHA mortgages all my life growing up. Our first FHA mortgage was $32,000 on a $35,000 home that my parents bought in 1976 in Fort Lauderdale, Florida. Our next FHA mortgage was the second home I moved into for $110,000 in 1980. I want to say 80. No, it would have been 85 actually. I remember it was 85. My father comes home with an 11 and a quarter rate, which at the time was the lowest rate you could possibly get. My parents were so happy to get an 11% interest rate on that hunt. Just goes to show where things come for those of you that are complaining about 6 or 7% interest rates today. So the FHA program is ironically ensuring the beginning of life, but it's also ensuring the end of life with the HECMs, with the home equity conversion mortgage, the reverse mortgage, the Tom Selleck mortgage that I refer to. And so when do those mortgages become due? They're reverse mortgages. Well, the tripping point, what makes those mortgages become due and payable is there's a few areas where a borrower can default. And I'll get into that. That's like not keeping up with the property, getting code violations on it, not paying the property taxes, or not keeping the property insured. Because that's your obligation until the day you die. You're living in that home, your job, the bank is paying you to live there. And your job is to just maintain the property, make sure the taxes are paid, the insurance is paid. But besides that, the way this whole thing unwinds is the death of the borrower, right? So that's the idea. The reverse mortgage is the death of the borrower, means that the loan basically has defaulted. It's not a negative default, it's a maturity default. If anything, the loan matures upon the death of the borrower. It becomes due and payable upon the death of the borrower. So if you borrowed $350,000 against your $1,000 house 20 years ago, chances are that the interest now is maybe built up, and you maybe been taking payments or not making payments. So that interest that is owed on that loan just gets tacked onto the loan. And so by the time the borrower dies in his 80s, let's say, and then the interest on that loan might have built up to 550,000. Now, in many cases, the value of the homes have also gone up. So you have the heirs, or whoever steps in can come in and sell the property in some cases, pay off what's owed on the reverse, and then keep a little extra. That happens once in a while. But what often happens, if the borrower succeeded in outliving the interest payments on, then the mortgage should end up greater than the value of the property. That's a success if you, from the borrower's perspective, from the dead borrower's perspective, from the person who took this mortgage 10 years ago, 20 years ago, 30 years ago in their 60s, if they die and the mortgage is owed is more than the value of the property, then in their minds, that's a success. They won the game, right? And that's where the government comes in, pays off the bank, takes back the mortgage, ownership of the mortgage, and the HUD will buy these mortgages. That's how the insurance gets paid. The insurance gets paid, and not on all of them. So you've got maybe thousands of people dying a month in this program. And the other important thing to keep in mind is there's some other key elements, such as borrower's spouse gets to stay in the property. So if husband and wife have a reverse mortgage, or the husband took out a reverse mortgage on a home that he and his wife live in together, if the wife outlives him, then that does not create the event of a maturity default. You've got a borrower's spouse is allowed to live in the property until they pass away as well. So that's even more of a reason why these mortgages often end up owing more than the property is worth. So at that point is when the banks will decide to uh, to go to HUD and sell the mortgage back to HUD. That's their insurance policy, right? The insurance policy is that the borrowers outlive the payments on this mortgage, and now the mortgage payoff, the balance owed on it, is greater than what they can derive from the sale of the property. Then the banks will go and sell that mortgage back to HUD. What does HUD do with the mortgages? Well, that's going to be part 2 of this podcast episode. That's what we're going to get into in the next episode. We're going to dig down deep and dirty without revealing too many secrets. We're going to share with you information about a program that HUD does to sell these mortgages in bulk to nonprofits, for-profits, private equity. They hold these government auctions a couple of times a year, where they sell. You have to be able to buy at least 5 properties at a minimum. So you can't it's not just like a one by one, but it's a bulk sale 2 to 3 times a year of the mortgages, because the federal government decided long ago after the GFC that they really don't want to be in the foreclosure business. And yet that's the only way to resolve a lot of these mortgages. What happens with these mortgages is they can also go into default in a couple of other ways. There has actually been a surprising increase in the number of defaulted mortgages before the death of the borrower. And those are defaults, but when you're dealing with a senior citizen living in a home in a federally insured government mortgage, it's not the kind of default that you and I think of as a lender default. You're not going to kick grandma out of the home, right? That's a federally insured program, so those lenders have to work with those borrowers. As a matter of fact, some of the interesting stats here, by the way, the Government Accountability Office reported that defaults increased from 2% of loan terminations in 2014 to 18% by 2018, primarily borrowers failing to meet occupancy requirements or paying property taxes and insurance. So that's another thing, by the way. You can't take a reverse mortgage out and then go move to, an island somewhere and rent out the house on top of that. That's double dipping, right? But property taxes and insurance, those are important things. Another interesting thing, it's estimated that nearly 1 in 5 reverse mortgage loans taken out between 2009 and 2016 are expected to go into default because of unpaid taxes or insurance. So that's another aspect that I think that those that are owning these reverse mortgages, banks and private equity groups, are obviously, they're sensitive to that. So, like I said, you have to keep the property in good shape. You've got to pay the property taxes. You got to pay the insurance, and you got to not die. Now, once you die, it's all over. Once you die, and then your spouse dies, then the loan gets sold back to HUD, and that's when it gets once the property is vacant, and HUD has taken back this mortgage, and this is obviously when they will sell it to us. There's not clear data on what percentage of the loans in the HECM program actually get sold by the banks back to HUD and where they take the insurance versus what percentage the banks are able to, still have equity in the home and the heirs come and just make a payoff. But it is important to know that 99% of the reverse mortgages out there are federally insured reverse mortgages. And by them being federally insured, that's what allows them to exist. And that's what allows them to exist at relatively reasonable interest rates, like, the way the rest of us get it. The interesting thing is that that there's a whole process where the loan gets assigned from the lender to HUD. This is not a program that we get involved in personally as investors, because we have some of our friends in the business that have participated in this, and it can be a harrowing experience, because you've got to make sure that you're keeping really good records of stuff. But the bottom line is that HUD takes assignment of the HECM. Once it's assigned to HUD, the HUD becomes a mortgage lender, takes over servicing duties through the National Servicing Center. The borrower a lot of these loans get paid off by the estate, during that period, or a letter gets sent to every heir saying, hey, even if you owe $1,000, for instance, on this $400,000 house, HUD will allow you, I don't know, 90 days or as the heir, 6 months, some period of time, to pay 95% of the value of the current value of the real estate as the payoff. Now, it's basically a short sale of the loan, of the property back to the heirs by HUD. And so that's another way that these things get resolved. So, it's a very interesting program, and one in which I think it really does kind of grease the system and allow a lot of borrowers, a lot of people, to access the home equity without ever having to move, really live off of, that savings. So I think it has a lot of benefits. And then at the end of the day, what happens? The borrowers pass away. The federal government, the U.S. taxpayer, you and I, we sit there and we insure this. But this is a pretty inexpensive safety net. It doesn't lose a ton of money. And then because it's a real asset, there are buyers for it. It's not like some of the mortgage securities that the U.S. government or the Fed or Treasury bought after the great financial crisis. These loans are first liens government on real estate all across America, residential real estate, mostly residential. There's some multifamily in there. So they retain value. And like I said, if you're looking at doing a reverse mortgage, you're considering doing it, I'd say now's a great time because you're not going to see in my opinion, a value of residential real estate comparative to the income levels generated by that cohort is just such a high ratio right now, meaning it's so expensive to live and own and buy real estate that it's cheaper to rent or whatever it might be, that now would seem to be a good time if I was a borrower in my 60s to want to take this. For me as an investor, I love this program. This is going to be a nonstop source of residential real estate product, and I started buying these from the HUD Office of Asset Sales about 4 or 5 years ago, and I started buying them through a nonprofit. Then I started buying them, just as a for profit. But the Office of Asset Sales coordinates the sale of these mortgage notes. You have to be in the business of buying mortgage notes. They're not buying the real estate. We're buying them first and second lien mortgages. Gives us the ability to act as the lender, to step into the shoes of the lender. I think it's a win-win program. I'm a win-win kind of guy. I can go out and we're going to talk in our next program about this upcoming auction in just a few days from now. And what I'm going to do on our next episode, the second part of this conversation about the reverse mortgage program, these HECMs, is I'm going to get into how we value these things, how we look at them, a little bit about how we prepare for auctions like this one that I'm showing you here today. So that's the story behind the HUD HECM program. It is quite an interesting opportunity on all fronts. It is a system, like I said, I do not see retiring anytime soon. It is a federally backed program. It doesn't lose a tremendous amount of money, and the backstop it prevents for our aging population here in America way outweighs the cost. So I see this program being here for years to come. It's good on the front end for senior citizens who are on a fixed income, don't have a means, but they have this big asset in their home that they can access the equity from. It's good for keeping the system, keeping shelters. And it's good for us as investors because we have access through our relationships at HUD to sign up for these auctions, to buy these mortgage notes, in pools, minimum of 5 at a time, and we bought up to hundreds at a time. And then we go out as private equity investors and we work with the heirs and take the deed in lieu back to the property. We invest $50,000 or $100,000 in these properties. You have to assume most of these homes are not updated, they are not well kept. So we're out there reviving communities, bringing this product, recycling this product where the older generation is now passing away. They are moving this product through the system. We're buying it, we're fixing it up, and we're selling it back to the open market, providing new home ownership. It's ironic, actually, when we take a reverse mortgage that we have bought. I mean, I remember one case in Florida. I'll leave this with you as we finish here. There was a case in Florida. A gentleman built the home. He lived there for 35 years, built it in the late 80s, passed away, just recently. And so built the home, lived there, well kept, but dated, needed some repairs. I think we need to put a new roof on it. We come in, we buy this home, we buy the mortgage. We negotiate with the heirs. Unfortunately, the payoff was much higher than what the property is worth. We offered the heirs to buy the property back at property value. They just were not in a position to do so. But the good news is that home turned over to a first-time home buyer family with a newborn, and it's just great to see the cycles of life. And I think a lot of what we look at, and a lot of my philosophy of life is that life is cyclical, markets are cyclical, and the reason that I've been screaming from the rafters that the next cycle must come is in order for life to proceed, and in order for things to move forward, one thing must end for a new thing to open. And so this is just another one of those programs that's part of the cycle of life that we at First Lien Capital have been able to insert ourselves in and make a few bucks doing, and obviously making an impact on society as well, which is our thing. Make sure you like this episode, subscribe, and tune in to part 2, where we talk about how we value these upside down mortgages, these upside down HUD heckums, when we value these mortgages in order to bid on them, which we're going to be doing in just a few days, so stay tuned. Thanks for listening to this episode of The Debt Doctor. We'll see you soon. That's a wrap of today's episode of Debt Doctor. I enjoy bringing this content to you each and every week, and I really appreciate you tuning in. Remember to follow us so you get notified whenever new episodes release. If you haven't already done so, please share one of your favorite episodes with a friend, family, or colleagues. And if you don't mind, leave us a positive review on Apple, Spotify, or whatever your favorite listening platform might be. Until next time, thank you for investing your time with us on The Debt Doctor.